Welcome you all for the today's discussion on drafting accounting policies, notes to accounts, and other matters. To handle this session, we have an eminent speaker, none other than Praveen C G. He is very well versed in this matter. I request our Secretary Pramod Hegde to welcome Praveen C G with a floral bouquet. Thank you, Pramod. It's a very interesting session because for so many reasons, we need to focus on this area because we need to draft very well. Even if our students has draft, we should not skip this item while finalizing this drafting of accounting policy and notes of accounts. Generally, once accounting policy drafted first year of filing, after that we'll never focus. It needs to be focused every year before filing because we are getting some of the notices from ROC and it's a best practice. It shows our skill, how we have done, what whether we have understood that industry or not. So many things. It communicates to the third party how we draft, what is the quality in that. That is the reason we have kept this session. When requested Praveen sir, he immediately agreed and he has come to address our members. And if you can see some of the best presented audit reports like Infosys and some of the listed companies, how they present very, very beautifully, and it will be ready immediately after the March. Their financials will be ready with so many reportings that you and you and me can do that. Only thing, adapting a good practices. We should learn. We should review each year while finalizing our draft report, and we should present in a better manner. With this, once again, I welcome you for a very interesting session, and I would like to give a small announcement. I would like to make a small announcement. We have planned on August 19th and 20th state level conference, joining together with all other 7 branches of the Karnataka. This time we are doing this state level conference in Palace Ground, Anantya. I request all the members block your calendar for August 19th and 20th. Please attend this program and make it a grand success. We are hoping that our president and vice president both are attending this program. I request members to join. Another important notice is that on 19th July this month, we are having a full day seminar on trust, charitable trust. I request member to register also. With this, I welcome you all once again. Over to Pramod.
Thank you, Chairman. I would like to take this privilege of introducing Mr. Praveen C G, who is a chartered accountant, CPA USA, and Bachelor of Commerce, who is currently an associate partner in Price Waterhouse. Mr. Praveen C G is based in Bangalore and has over 15 years professional experience on a variety of clients in manufacturing, consumer goods, retail, and IT industries. Praveen was on secondment as a part of the national office in the Netherlands, where he was a part of the Global Accounting Consulting Services ACS team. Praveen is now part of the India ACS team, where he assists audit team on consistent application of IFRS, Ind AS, and regularly contributing to the firm's thought leadership publications. He is currently working on an engagement partner on a large listed companies in India in retail and consumer industry. He is also the signing partner on various private limited companies in manufacturing and service sectors. His key expertise includes he is an audit engagement partner on listed companies in India operating in consumer goods, manufacturing, and technology sectors. He is an audit signing partner for various private limited companies operating across a number of industries. Praveen has experience in providing IPO advisory services to clients in IT industry. He was on secondment to Amsterdam for 2 years, where he was focused extensively on internal technical activities, including contribution to the thought leadership publications. Training and assisting audit teams with application of IFRS standards. He is also an author and a contributor to PwC's IFRS Manual of Accounting. He is also part of PwC's Global IFRS Accounting Consulting Services Group and a member of Non-Financial Instrument Technical Topic Team. He currently works part-time with the national office in India, where he assists audit engagement teams with application of Ind AS. He's a regular contributor to the firm's thought leadership publication, PwC's Reporting Perspective and PwC in Brief. With this brief introduction, I would like to hand over and present to you all Mr. CA Praveen CG. Over to you.
Thanks, Srinivas. Can you hear me?
Yes.
I'll just share my screen. So thank you everyone, and thanks for taking time out to attend this session. As Mr. Srinivas said, accounting policy is a very important part of the financial statements, accounting policies and notes to accounts. And when this session was given to me, I was just thinking, when you look at a financial statement, so there are essentially two parts to a financial statement, where you look at the balance sheet, P&L, and the cash flow, and statement of changes in equity in Ind AS, and those would be called the primary financial statements. The second part of it is where you will see the accounting policies and notes. The first part is where you will only see the numbers. You will not see you will not get the complete understanding of the story behind what has happened behind the numbers. But if you need to get to the story, if you need to understand the story behind the numbers, the best place to look at is look at the accounting policies and look at the notes to the financial statements. And that's why this is very important. So in this session today, I mean, essentially I've split this into the way that if you look at an accounting policy statement and notes on financial statements, in a typical Ind AS financial statements, that has got typically three parts. One is the standard accounting policies that you will have to follow. The second part is what you call as critical accounting estimates and judgments. And third part is where you will have the notes to financial statements. Notes is where the accounting standards prescribe companies to disclose a number of items. And I've split that in the same order in which financial statements would be put. Primarily, I have made my presentation and discussion today based on Ind AS concepts, but most of these concepts will be applicable even for Indian GAAP. There are something which is more in Ind AS, which is not in Indian GAAP, but principally the way we do Ind AS should also be applicable even for Indian GAAP. Okay. With that, maybe just I'll start with the introduction, the definition of an accounting policy. So what is an accounting policy? To put it very simply, accounting policy consists of specific principles. Now, when you say a principle, where does this principle come from? It comes from the accounting standard itself. So if you have a standard on property, plant and equipment, that standard will tell you to account property, plant and equipment on the date when you get control of that property, plant and equipment. You record a sale when you lose control. That concept of control comes from accounting standard. So you will look at accounting standards and then determine your accounting policy. Accounting policy will also tell you basis on which you will measure, right? So if you have a inventory standard will give you an option to measure inventories at weighted average cost or FIFO method. Again, the PPE standard will tell you to measure inventories or PPE at cost. Subsequently, you have a choice to measure it either at cost or using the revaluation method. So basis is also prescribed by the accounting standard itself. So these two are pretty easy, where accounting standard prescribes what has to be done. The difficulty arises when the accounting standards are silent on certain items, right? And that's where you look at whether others in the industry are doing something. There is a practice that is established. So if there is an established practice, you can consider such established practices in determining your accounting policy. But a word of caution is that you need to be careful, because what is applicable to others may not be applicable to you. So you need to be very conscious that it is exactly fits your fact pattern before you apply that. The other thing that we also consider is, there could be guidance given by the institute, whether it's ITFG or any other mode or fashion. You will consider even those publications in determining your accounting policy. Right. So if you look at what is an accounting policies are specific principle, basis, convention, rules, and practices applied by an entity in preparing and presenting its financial statements. Now, needless to mention, all accounting policies have to be applied consistently. The reason is simple, because when you're preparing a financial statement for the current year, that has to be compared with the financial statement that you prepared in the past years and financial statement that you want to prepare in the future. It is also important that it is comparable with financial statements that others have prepared. But if you have inconsistent accounting policy, it makes it difficult for people in the industry to compare your performance with others. So it has to be applied consistently. If you have any questions, how do we handle this, Srinivas?
We do have
A chat box. Okay. We'll take it at the end, right? The questions. Or, yeah. Or should we split it after accounting policy before we go to the notes? Is that okay?
As of now,
we don't have any questions. Yeah. Okay. After learning about the definition of accounting policy, the next important thing is to understand how do you apply this in practice? How do you draft an accounting policy? The first thing is what we already discussed. The first thing that you will refer to is you will refer to either an IGAP standard or you will refer to an Ind AS standard and see what is an accounting policy prescribed by that standard for a particular event, transaction, or a condition. Many of these Ind AS standards especially gives you choices. It gives you a choice to either do a cost or a fair value. It gives you a choice to account certain items in OCI or in P&L. If you have such choices, which is prescribed by the accounting standard, a company in the first year when it is applying this, it has to make a conscious decision of why a particular choice is relevant to them and apply that. So once that choice is made, it's very difficult to change. So the year one, when you make this choice and apply that standard, it's important that you're conscious about why you're applying it, what is the benefit, pros and cons of applying a particular accounting policy choice over another. Right? Now, the standard contains in most places, and although the Ind AS standards are very extensive, most places it contains basic guidance. After looking at the guidance, you will still not be convinced on what the standard talks about, or you would want more information to understand the truly understand how to apply a particular accounting standard. That's where the guidance accompanying the accounting standard comes into play. And this is another source that you will consider when you determine your accounting policy. If you look at the Ind AS standards, there is a Annexure B, Appendix B in all the standards. And that is an application guidance for each of the standards. And it's referred to each of the paragraphs in the standard itself. So you will refer to that before you define your accounting policies. Okay. Now, once you've imagine a scenario, you have a transaction, and after looking at the guidance available in Ind AS, you conclude that the standard is silent. Now, how do you determine an accounting policy in that situation? Typically, we encounter this in a court scheme, right? In India, we have a lot of court scheme where you have legal mergers between entities. And when you have a legal merger, there is a business combination standard in Ind AS, which you will apply. But some of the court schemes, some of the amalgamations that we see in India, it will be of a new company which has just been established. You may just have share capital and cash, or it could be a company which is on the verge of it's hived off all its business. There could be certain cash or tax provisions, and they want to merge it for whatever reasons. Now, technically, if you see, this doesn't meet the definition of a business, but you need to merge them. And if you technically look at the Ind AS standards, none of the standards speak about how to account for such amalgamations or such combinations. Right. So that is where the use of other relevant information comes in when you determine what accounting policy should I apply. So the first one, when you encounter such situations where there is no guidance in Ind AS standards, you'll have to look at what is relevant to the economic decision making. When a user makes a decision, economic decision about whether he has to invest or whatever purpose, depending on the user, whatever purpose, if he needs to make a decision, what was more relevant for him, what would impact him, that is the primary consideration. The second consideration is that the way you determine an accounting policy, it should be reliable so that the information is faithful, it reflects economic substance. The accounting policy that you choose is neutral, prudent, and complete. Now, when you have such situations, the standard also prescribes the order in which you will go through this list to determine what an accounting policy should be. So the first thing that you will refer to is you will refer to India standard itself. You look at other standards. In my example, I had a business combination example, but I determined that this is not relevant, this is not applicable. So then I need to look at the India standard itself to see that are there any other standards which give guidance which is suitable in this scenario, right? And in my case, let's say I had debtors and cash and no business at all, or any other financial assets, or even PPE, for instance, but it doesn't meet the definition of a business. Then I would see, should I account them individually? I will not put a business combination standard. Should I account individually? And I will go to that relevant standard and say, maybe that PPE standard is relevant. Maybe the financial asset standard is relevant. Financial instrument standard is relevant, and I'll apply that. So the first source is you will look at India standard itself to determine an accounting policy. It is virtually impossible that once you look at other standards, you will end up with an answer that there is no other standard that gives guidance. But it may happen in some instances that there is no guidance. It's extremely rare, but this is the theory. That's why I'm just telling you the order that you need to follow. Once you look at India's guidance and then say that there is no standard at all, which is even remotely comparable, then you look at the requirements in the framework. Right. Once you look at the requirements in the framework, you will determine an accounting policy which is in compliance with the framework. After going through this step, if you still determine that there is not possible to have a suitable accounting policy for your transaction, then you will look at the recent pronouncements which are issued by IASB. IASB issues IFRS standards, and more or less we pretty much follow the standards that are issued by IASB. So the first source that I will look to, first external source that I will look to is IASB. If there are any pronouncements on this topic, on a relevant topic that you're dealing with, and that is issued by IASB, you will look at that. If you've exhausted that, you will look at other standard setting body. I will go to IASB because IASB is what I generally follow. Maybe FASB has got a standard or a pronouncement which is similar to my transaction, so I will look at that. After that is when I look at any other accounting literature or accepted industry practice. Now the question could be, can I not go through this rigor of following this order and just jump into I'm doing I have a transaction for which there is no suitable accounting policy. Can I look at someone who's my neighbor in the same industry? Can I just take that accounting policy and do a lift and shift? The answer is no. You need to walk through this process, step-by-step process. Only once you exhausted all the options is when you look at other industry practice. Yeah. Okay. So far what we've discussed is how do you determine an accounting policy when you initially have a transaction. Maybe one point that I want to highlight is that if there's an accounting standard that is already there, let's say for a business combination, but in the past you've never had a business combination, right? So this is a new thing that has come to you. This is a first business combination that the company has got, and if you apply that business combination standard, you are applying that policy for the first time. It's not a change in accounting policy. The first time when you apply that for a transaction, it's the initial application of an accounting policy. It's not a change, right? So, but what we are now talking about is you're already following a certain accounting policy, and for whatever reason you decide to change it. Now we'll discuss what are the requirements, what are the disclosures that are required if and when such a change is required and such a change is made. So the first one is generally you change accounting policy when an India standard requires you to change, which is very simple. I mean, we've known recently the revenue standard was changed. We know that the lease standard was changed. The standards required you to move away from the old standard and move to a new standard. We did that. The second thing is you do a voluntary adoption. Why would you do a voluntary adoption? You would do a voluntary adoption only when the information that you will get after applying the new standard gives you more reliable and more relevant information. And both these conditions are to be satisfied. It's extremely rare. I mean, it's virtually rare that you will ever do a voluntary adoption, a voluntary change in the accounting policy. Because once you apply an accounting policy for a particular transaction, there is a strong reason why you've done that. And then to say that I will move away without any change in other facts and circumstances, it's virtually not possible at all, right? But even when such an event has happened and there is a need for you to change, you will have to do it only when it provides more reliable and more relevant information. So, so the first one again, when the standard requires you to move from an old standard to a new standard, the new standard generally has a transition guidance. So you will typically follow the transition guidance given in the accounting standard and follow that. Now, if you do a voluntary change in accounting policy or a new standard does not have a transition provision, generally any changes in accounting policy have to be accounted retrospectively. Recently, the new standards that we've seen on revenue and leases, they have provided for transition. At least in India, we don't have an experience where a new standard has come in without a transition provision, and then you're struggling to see how to move from the old one to the new one. But generally, the new standard do have a transition provisions. But in case transition guidance is not there, or you do a voluntary switch from one accounting policy to another, you will have to do that retrospectively. We will look in the next slide on what this retrospective application means. So as I said, when you do a retrospective application of the accounting policy, or when you change an accounting policy voluntarily, you'll have to do a retrospective application, which means that you need to do this adjustment or you need to do this transition from the first day of the previous year. So what does it mean? So if you're preparing financial statements for March 22 and you decide that until now I've been carrying my investments and subsidiaries at cost, but today I've decided that that is not more relevant, that is not reliable compared to the fair value, and I need to move from cost to fair value. I will have to do this from 1st April 2020. So 1st day of April 2020 is the opening balance sheet for the prior year. You will have to determine a fair value on that day and account the difference between your cost and fair value, generally in retained earnings or equity. And you'll have to account that in the balance sheet at fair value, account the investment in the balance sheet at fair value. Once you do that opening balance sheet restatement, you will have to do the restatement for the comparative period, because you have a P&L for 2021, which was assuming a cost basis. So you have to go and restate the last year's P&L, and then you will do the regular accounting, follow the new accounting policy in the current year. And this is essentially what happens when you apply a retrospective application. Now, it may happen that when you apply, you made a choice to make a voluntary change in accounting policy, but you decide that, but when you actually get down to giving effect to that from the first day of the previous year, retrospective application is impracticable. Now, when you encounter such a situation, the standard gives you an option to not to adjust the opening balance of the previous year, but do the change from the opening balance sheet of the current period. So in my example, again, you will have to do fair value on 1st April 21, account it from 1st April 21, and then move on applying the new policy. It is also possible that you don't have a fair value or you're unable to determine a fair value on 1st April 21. And if you encounter such a scenario, then you would do it in the current period prospectively. But these two options of saying that, it is impracticable for me to go back to first day of the previous year and therefore I'll do it from the first day of the current year or in the current year itself, will that be applied only when it is impracticable? I mean, impracticable, the word sounds very simple, but in accounting terms, you will never achieve impracticability. Difficulty in getting information is not impracticable. You will, it's virtually impossible to say that it is impracticable to get information, because I mean, I have not encountered a situation anywhere where you've said that it's impracticable, so I will not apply this policy. That's never happened. But in case that situation is there, this is one of the options that is possible. Okay. So once you change an accounting policy, meaning you changed either through a voluntary change in accounting policy or because a standard has required you to change it. Generally, when a standard requires you to change an accounting policy, the new standard will give you what are the disclosure requirements from moving from the old one to the new one. And this situation generally talks about a change which happens when you voluntarily change accounting policy. So when you change an accounting policy, then the Ind AS standards require you to disclose the nature of the change in accounting policy, right? And so once you change the accounting policy, you would have made adjustments either to the current period or to the comparative period. The amount of adjustment that you made to the opening balance sheet or to the previous comparative period, that amount should be disclosed for each financial statement line item that has got affected. If it is impacted earnings, if it's an item that is impacted last year's P&L, the impact on earnings per share has to be disclosed. If you determine that it has become impracticable to apply the accounting policy retrospectively, you have to determine the amount that you made adjustment to the current period instead of making it to the last year. You would also have to disclose what are the circumstances which caused you to determine that retrospective application is impracticable. I mean, you may say get to an answer that is impracticable because I've not got the information. It is virtually difficult to get the information. It is time consuming, but you cannot disclose those reasons in the financial statements. So it is difficult, time consuming. Those are not acceptable reasons. The bar is very high. Now, if you did not apply the retrospective application because it was impracticable, the standard also requires you to disclose. If you did not apply retrospectively, how did you apply this? You need to make that disclosure. And for voluntary changes in accounting policy, again, you'll have to disclose why new accounting policy provides more reliable and more relevant information. Now, in my case, example that I took, you were following a cost model for investments in subsidiaries, and then you switch to fair value in one day. You'll have to justify why it is more appropriate. It could be that you're going for a IPO or you're going for a delisting, and that's an event that you will consider why you're moving from cost to fair value or otherwise. Or it could also be that everyone in the industry is following some other policy, but you as an unlisted company were following something else. But once you are on the market, when your financial statements are published, you want to have a different policy. That's a different argument. So there could be certain circumstances where a voluntary change is necessitated, but this has to be carefully thought through. Okay. So one of the other sections, when you look at the financial statements that we prepare under Ind AS today, one of the sections that you see in the accounting policy section of the annual report is that there is a disclosure requirement for any new standards or amendments which have been issued but not yet adopted by a company. And this typically in Indian scenario arises when, let's say, an MCA has notified a standard, it's got gazetted before March year end, but it is notified before March year end, and it's going to give you time until next year to apply. And typically we saw this in lease. It was notified in March 19. It was applicable from April 19. Since it is already gazetted in the standard, the Ind AS standards require you to disclose what would be the impact of adoption of new standard in the future, in the next year, right? So I mean, there are specific disclosure requirement, and I mean, I'll run through the list. The first is that you should have to disclose the title of the standard. In my example, again, I'll say that you'll have to disclose the standard as leases. You would have disclosed the standard as leases. What is the nature of the change? You were earlier following, let's see, in earlier cases were following an operating lease model. But with this new change, mostly they would capitalize all the leases on the balance sheet. Now, if you capitalize all the leases in the balance sheet, your asset value is going to go up, your liabilities is going to go up. So you'll have to disclose the impact of that change. You'll also disclose the date by which you will apply the standard. Now, typically in India, when you have a standard notified, the standard will say that this is the date on which you need to apply. So typically the date is mandated. if you say that, once you make an impact assessment, you'll have to disclose that this is the impact that it's going to have. But it is also possible that at the time when you're preparing the financial statements, you've not made a full evaluation. And you'll then say that I'm in the process of making that evaluation and the impact is currently not known or estimated. Now, this generally for listed companies, it doesn't look nice that you've not made that assessment, because the idea is that investors need to know before the next year, this is going to be the impact of the new standard on their earnings, on the EPS, EBITDA, any other important measures. So it's important that this information is given. So typically for listed companies, it doesn't look nice. It would not be acceptable by investors if you just say that I'm in the process of making this assessment, especially for those items which are really material. Right? Okay. So let's now look at practical examples of how an accounting policy, or how will you apply an accounting policy. The first one is that the first question could be that, how will you apply accounting policy? You're preparing a group financial statements, consolidated financial statements. And when you prepare a consolidated financial statements, there are a number of subsidiaries in the group which have their own accounting policy. It could be in different territories and they have their own accounting policy. Now the question is it necessary that the standalone financial statements have the same accounting policies as the group? The answer is no. In the separate financial statements, in the individual financial statements of the subsidiary, it is not necessary that they have the same accounting policies as the group consolidated financial statements. But when it comes to consolidation, so the parent takes all the financial statements of the subsidiaries and does a consolidation. Before they do a consolidation, before the parent does a consolidation, parent has to ensure that the accounting policies are uniform. So you will bridge that accounting policy differences before you account that before you prepare a consolidated financial statements. So this is an example of a change in accounting policy. Now, when you look at India's 116, the lease standard, it gives you an option to not account for short-term and low-value leases. It is possible that when you applied the standard, you have made a choice not to use this practical expedient, and then subsequently you decide that for whatever reasons I want to account for all leases. I don't want to use this choice. Now, once you make the decision, that's a change in accounting policy. Right? That's an example of a change in accounting policy. Now, another change in accounting policy is a change in the measurement basis. Now, when you applied the revenue standard, you could have considered that the difference between the time when I invoice and I get money from my customers, it is not significant. So the impact of financing is not significant. So I will not account the financing component separately. But subsequently, you will decide that for whatever reason that has happened, you will decide that no, I want to account that financing component separately. If you make such a switch, that change in measurement basis is also a change in accounting policy. Now, when I say change in accounting policy, you have to do it from the first day of the previous year. You have to go back. So when you make this change, you should be conscious that there are various other disclosure requirements. Okay. So far we only talked about anything that affects the accounting and the measurement. It is also quite possible that any presentation is also a change in accounting policy. The example here could be that under the government grant standard, the government grant standard gives an option to say that capital grants can either be presented as deferred income in the P&L, or it can be deducted from the cost of the property, plant and equipment. Now, the company may have made a choice to deduct this from the cost of PPE earlier, but now they made a choice to present it as deferred income for whatever reason again. But if that reasons are achieved, now such a change in presentation also is a change in accounting policy, and all the other requirements that we spoke about so far are applicable. Right. So it is important to remember that it's not only amounts that not only changes that affect the timing of recognition or the amount that you recognize in the balance sheet and P&L are considered as change in accounting policy. Even change in the way you present certain items in the P&L or in the balance sheet, even those are changes in accounting policy.
I have one question. Not a question, just I think it's more.
I think it's okay.
When we talk about the new accounting policy, so I understand that the subsidiaries and the parent company can have different accounting policy, but when doing consolidation, the amount should reflect the same policy. That adjustment has to be done.
That adjustment has to be done.
So, for example, if let's say my subsidiaries have done some investments and they are recognizing at cost, and the parent company has a policy of recognizing investments at market value, when I do the consolidation, have to change the value of the investments which are on my subsidiary's balance sheet to the market value. Consistent with me.
I mean, investment is not a good example, I would say, because with investment, what happens is, I mean, typically the presumption is that all investments are to be done at fair value. Unlike Indian GAAP, where you have that choice, I don't think that choice is available. But if it's maybe a good example will be that the parent is in retail business in India, and the parent in their retail business, they are taking a weighted average for their inventories as the accounting policy, and subsidiary in a similar business, right? Maybe a subsidiary, I want to make it even simple, subsidiary in the same territory and in similar business is using FIFO. Now, that is not a acceptable method, right? Because same transaction, same industry, you would have to have a uniform accounting policy. Though there you need to make that alignment. But when it comes to subsidiary separate financial statements, you can have a separate. We've already spoken about the last one. I'm not going to stretch too much on that. So selecting an accounting policy, especially a voluntary accounting policy, is not a free choice. The bar is very high. You need to prove that the change will provide information that is more reliable and more relevant than what you're already doing it, which in most cases will be difficult because you are already following an accounting standard. Okay, so when you actually do a change in accounting policy, there's another requirement that is specified by Ind AS standard. This is not applicable to Indian GAAP, but this is a exclusive Ind AS requirement. So when you make a change in accounting policy, let's say you moved from a FIFO method to a weighted average method for inventories, you will have to effect this change as we discussed from the first day of the previous year. In my example, right, where we had 22 balance sheet that we were preparing, you'll have to do it from 1st April 2020. But when you do that, you will also have to present a third balance sheet, which is on 1st April 2020. You'll have to present that balance sheet on the face of the regular balance sheet where you have the current year, last year, and there'll be a balance sheet on 1st April 2020. Now, there are requirements to be satisfied for you to present it. The first one is you made the retrospective change, which is obvious you've done that. The second condition is that retrospective application has had a material impact on the balance sheet of that period. On 1st April 2020 balance sheet, this change has had a material impact. If these conditions are satisfied, you will have to present a third balance sheet.
By the standard want this third balance sheet to be at the beginning of the previous year. Like for example, 31st March 22 anywhere I will put it. 2021 also I will put it 31st March. So instead of keeping it 1st April 2020, they should have kept 31st March 2020. Now why this one day difference? I'm like at the time, so balance sheet is a state of affairs. I'm like as on that day. So should I take my balances as of 1st April or should I take my balances as of 31st March and then do the adjustment?
So in practice, it's not different. I think the logic is
Or 31st March
yeah. So
2020 should be carried forward.
you will carry forward what is on 31st March 2020. You need to pass an entry on 1st April 22 to effect this change. Effectively, you cannot make that on 31st March 2020. The beginning point is this, and you will pass that entry and take it. And typically what happens in these scenarios is you're just making a change in one element or maybe two elements of the financial statements. one line item or two line items. So the remaining items will remain the same. In fact, one of the checks that we do is when you have such scenarios, you'll compare that March 20 and April 1 and see the differences, and only those two line items are affected. That's a check that has to be done. Okay. Maybe I'll just stop here for questions if there's anything. No questions, right? Okay, so in case there are no questions, I'll just continue. The second thing that I want to talk about, and this is again unique to Ind AS, this is not in Indian GAAP standard. This is again part of the accounting policy section of the financial statements. So this is a section called as critical accounting estimates and judgments. And any Ind AS financial statements that you pick up in the market today will have this section. So we'll discuss what are the requirements of this section in the financial statements. So the first one that we will talk about is there are two different concepts. One is estimates and another one is judgment. So the first one that we will talk about is judgment. So when you have an accounting judgment, so you have a transaction. Let's say you have a sales contract that you are evaluating. There are multiple elements in that contract, and you need to apply that. You also have an accounting standard to evaluate. So when you're evaluating the sales contract with your accounting standard, you will have to determine how many performance obligations are there in this contract, right? So when you make this determination, you will have to apply judgment to various facts and circumstances that are there in your business, your contract, to the requirements in the accounting standard. There could be some things which are very easy. There are some where it is very complex because the standard is not very clear or your contract terms are very complex. And there are various variations that could be there even in your regular day-to-day business. So when you have such situations and you make certain judgments in concluding on how many performance obligations are there, I mean, I'm just taking one example. So, and if that judgment that you make will have significant impact on the P&L, so that accounting judgment has to be disclosed. So maybe one example that I can give is you have a contract, you have a product and a service. Let's say a product is a machine and a service is an installation. You decide that both are different performance obligation, and because of your decision, you'll account product revenue in year 1 and installation in year 2, and that is having a significant impact. Maybe that's a significant accounting judgment you'll have to disclose in the financials, right? Why did you say that it's there are two separate performance obligations, right? So you'll account it in different periods. Now, again, like we spoke about, this section is limited to those items which have a significant impact on the amounts that you report in the financial statements. If it is not going to have a significant impact, you will not report it. For example, again, you have a let's say a sale of PPE, and you don't sell PPE regularly, or maybe sale of motor vehicles. Now you may have applied the same accounting standard to account for a sale of motor vehicle, but sale of motor vehicle is not going to have any major impact. You could have had similar scenarios where a party is not giving you money, there is some uncertainty on collection. So those are judgments that are already applied and you've done whatever accounting is right in that circumstance. But since that amount is not material, it doesn't impact users to an extent like a revenue line item code, you would not make that disclosure of such items. It is restricted to very few items, so you need to make that decision very judiciously.
This first example,
Yeah.
which you mentioned that if I have sale of machinery and the installation, I can make a judgment to defer. I can have it defer like to next year. Can I do it on a case-to-case basis, or it should have been a consistent policy? A few cases I decide, okay, I can do it together because the contract which I have is a total cost. I mean the total revenue, and there is no separate number attached. How much I would get it for installation, how much I would get it for machinery. But it is a consolidated amount which I get, and few cases I'm able to segregate and the contract is drafted in that way, I can shift it, or should I have a consistent policy here?
So generally, I mean, it's more an accounting rather than an accounting policy question. But generally, what happens is you will have similar products and similar installation. If that is your main activity, you will end up providing similar installation services to all customers, unless it's some real estate construction where you every product that you sell is bespoke. Unless and until that condition is met, you would have similar machines, similar installation. So whatever decision that you make on one will be applicable for others. But if it is an industry where you make products for specific customer, these are customized, then your answer could be different. There it has to be applied differently. So we spoke about so examples of accounting judgments could be different. Maybe a couple of them I'll speak about. We spoke about multiple performance obligations in our example. A typical thing that we also see is where you acquired a subsidiary, but you don't have a majority in the subsidiary. You also don't have board control. But what happens in some scenarios is that because you are the major shareholder, others are diversified, there are thousands of other shareholders, public shareholders. And once you make a decision, it's virtually certain that decision will fly through. Now, if you have such scenarios, you will have to explain why, despite not having majority and not board control, you're still able to control it. Now, that's another example of an accounting judgment. Principal agent, very common, very difficult to apply in practice. If you have such scenarios, most likely than not, this can become a significant accounting judgment. Going concern, it can vary. Maybe you have a loss-making company. You have, let's say, support from a parent. If you have such scenario, you may conclude that with this information, where I have losses in the current year, but I have cash flow projections for next year, I also have support from the parent. It is still a going concern. You'll have to disclose that why, despite having lost during the current year, you're preparing it on going concern basis. I will contrast that with another scenario where you have a profit-making company with positive cash flows, and they prepared on going concern basis. Now you don't have to do anything because there's no significant judgment in, right? So you need to see your circumstance, your situation, and then see what should come in accounting judgment. Okay. The second concept that we spoke about was accounting estimates. Now, what is an accounting estimates? These are generally assumptions and estimates that have a significant risk of resulting in a material adjustment to the assets and liabilities within the next financial year. Now, typical examples that we see is impairment test. Now, if you have a, let's say, goodwill that you're testing it for impairment, when you make that goodwill impairment assessment, you will have cash flow projections, you will have discount factor, you will have growth rates, you'll have various assumptions that have gone into that model. Now, each of those assumptions and estimates, you will have to look at and see which one is the most critical one, right? Now, typically, if you have estimated a growth rate of 20% of revenue, that more likely is going to be a critical accounting estimates, because if your revenue goes down to, let's say, from 20% in your projections, but the actual is 5, it can result in an impairment. So that typically becomes an area where you need to disclose that as its critical accounting estimates. Like judgments, even here, disclosure is required only for those assets and liabilities where it is likely to have a significant impact, where the inputs that you've used or the model that you've used has been difficult, complex, and any changes in that model will result in a significant change. Apart from judgments, for significant critical estimates, there is an additional disclosure requirement. It is called as sensitivity disclosures, which means that if there is a change in revenue growth rate by 2%, it will result in an impairment. That sort of a disclosure has to be given. Or it could be that any possible change in any of the significant estimates, there is not likely to be an impairment. You can disclose that as well. But again, that sensitivity disclosures has to be limited to those assumptions in the model to which the model is more sensitive. Now, you can have a discount rate, and if you change the discount rate by let's say 2% or 3%, even then the model is not sensitive. You would not make that sensitivity disclosures for discount rate. You'll have to do it for items for which the model is more sensitive. And generally it is for revenue growth rates, cost estimates that you've done, long-term revenue growth rates, right? So those are the items which generally have a more sensitivity or create a more sensitivity in the model. So when we talk about accounting estimates, examples of accounting estimates will be when you determine a lease term, you have a lease contract and you have various extension termination options. You have to determine a lease term that becomes a significant accounting estimates. Uncertain tax provision again is a matter of significant accounting estimates, because you may have claimed certain amount in your tax return, but the tax officer may not allow, or you have a past history where there is a disallowance. Now that creates an uncertainty, so that is a matter of significant accounting estimate. Provision for warranty, again, there is no science behind provision for warranty. Generally, companies do based on past history. They determine a rate at which warranty is claimed. So if there's slight change in the claim compared to what has been there in the past, that is a matter that could be a significant accounting estimate. Impairment assessment of goodwill we spoke about. Okay. Now, what are in that section, when you come to critical accounting estimates and judgment, how do you make a disclosure? So the first thing is that there has to be a distinction between accounting estimates and judgments. And how do you make the distinction? We'll look at certain examples in the subsequent slide to understand that better. But principally, judgment is something that you made in applying an accounting policy. Estimate is one that actually determines the value of an asset or liability. Right? Anything to do with the numerical amount of assets and liabilities or revenue cost that you recognized, it will most likely be an accounting estimate. Judgment is more principle based. If you've applied a principle and behind that principle there is a judgment that is there, that's an example of an accounting judgment. One of the things that you should avoid here is boilerplate disclosures when you make these disclosures in this section, the financial statements, because typically what we see is people repeat what is already there in the accounting policy. I mean, a typical example will be that I have not recognized deferred tax asset on losses because I do not have certainty or reasonable certainty that I will recover. Now that is already a requirement in the accounting standard. You already adopted that accounting standard. There is no need to give that disclosure here. Now the question here is why did you not anticipate that you will not have future profits? What is the reason? Or if you ended up recognizing a deferred tax asset, why did you recognize that deferred tax asset? What are the reasons? Now it's an accounting estimate. You'll have to provide sensitivity disclosures. How did you project your revenues going forward? Would that change in revenues have a change in the amount that you recognize? That is the kind of disclosure that is required. So I think the point here is there is no need to repeat what is already specified in the accounting standard. This is more specific to what you decided is an critical accounting estimates or a critical accounting judgment. So I mean, I just put certain examples of disclosures which are not very helpful to your user. So the first one that I put was the lease classification. Now for a lessor, if you have a finance lease or a operating lease, if you have an accounting policy which says that lease classification has been a matter of accounting judgment, that doesn't add any value to any user unless and until he knows which lease are you talking about and what was the judgment you applied in making that judgment, right? So it's important that that piece of information is provided in the financials. This is another interesting one. So where you see service industry, where typically they have laptops, servers, maybe furniture, fixture, and leasehold improvements, but useful life of a property, plant, and equipment is a significant accounting estimate. But typically for a service industry, assets, they're not asset heavy. Right? They're heavy on people. They make investment on people. It's a more knowledge industry than property, plant, and equipment. And having this kind of an accounting policy doesn't suit a service industry. Or you can also have scenarios where PP itself is immaterial to the financial statement, but you would call it as a significant accounting estimate. Even that doesn't make sense. And uncertain tax positions again. I mean, typically in consolidated financials, you sometimes see uncertain tax position as a critical accounting estimate, but it does not specify in which geography, what is the tax matter, which subsidiary is affected. So it's important that all this information is provided in the financial statements. Okay, let's now look at certain examples of how to apply and understand which is an accounting policy and which is an accounting judgment. So the first one is, let's say, a service company which has to determine whether income from claims and penalties is to be recognized. So there's a contract term which says that whether that company has to recognize claims and penalties as income. Now the question is whether this is an accounting estimate or an accounting judgment. I mean, I'll just give it a pause. It could be both actually. So when you are actually looking at a contract to determine whether there's a default and whether the default results in a claim, that's a matter of judgment. But when you're actually going ahead and seeing how much should I estimate and recognize, then it can, sometimes even the contract terms make it an accounting estimate and a judgment, but it can be both. The second one, I think it's simple, we've already discussed. So when you're actually going and determining something which is a numerical value, the amount of income in this case, that becomes an accounting estimate. The third one, company has estimated the useful life for motor vehicles as 3 years, and it has a policy to replace vehicles after every 3 years. Is this accounting estimate or a judgment? It's actually neither, right? Because I mean, it's on the ground, it's a fact. Every 3 years I replace vehicles and I have a useful life of 3 years. So, I mean, there's no judgment involved, there is no estimate involved. The last one is company has determined that installation service is not a separate performance obligation. This is a judgment because again, you're applying judgment on an accounting policy matter. It doesn't deal with numerical values, amounts in the financials. Okay, so I mean, I will not try and explain this. So these are examples in some annual reports of good accounting policies and good accounting judgments and estimates. So the first one, if you refer, they are saying that they had no accounting judgments in that year. So they're making it clear that there were no accounting judgments. It was whatever is disclosed in the accounting estimates. The second one is a accounting estimate, and this is for provision for doubtful debts. If you look at that, they say that earlier it was a significant accounting estimates. Now the amount provision for doubtful debts itself is not material, so it's no longer a significant accounting estimate. So this is an example of how to determine an NRV for an inventory item. Maybe I'll just give a minute for people to read. Okay. The second one on the right, it actually gives you a estimate or a range of how the an uncertain tax provision may pan out. So they put a ballpark range of this. This is the worst impact that can happen, and this is the best scenario that can happen. But my estimate of the outflow is likely to be within this range. So that's another estimate of accounting estimate. This is another sensitivity disclosure. So if you maybe it's an impairment assessment and they are saying that there's a change in cost estimate by 15%, this is likely to be the impact. So that's a disclosure of an accounting estimate. The last one on the right is where you go and disclose sensitivity disclosures, provide sensitivity disclosures for significant accounting assumptions. Now, for each one, you have assumed that what could be the sensitivity range, and if that sensitivity range pans out, what could be the impact on the amount that I've already recognized in the financial statements. Okay. Now, after having learned what the standard says, I mean, I just put out a list of items that you should consider when you're actually drafting accounting policy. So the first one we already spoke on, boilerplate disclosures for significant accounting estimates and judgments. And this is applicable not only for accounting estimates and judgments, but it is also applicable for accounting policies itself. Now, when you have a revenue policy, and revenue policy of a company reads that sale of goods is recognized when significant risks and rewards are transferred. A person or a user who's reading it would not even understand what industry we're talking about, what are the nature of the products you sell, when are those significant risks and rewards transferred, because significant risks and rewards is there in the standard, and you just picked up significant risks and rewards and put it here, right? You will have
even for deferred tax, they say that there's no reasonable certainty, that's why there is no deferred tax acceptable. But I have hardly seen where they've actually avoided the copy paste language of the accounting standard rather than explaining it in more deeper. Hardly is this practice actually?
There are, I mean, I think there are good examples also. Now, significant risk and rewards, transfer of control, you see in very common, but there are people who actually explain for each streams of revenue. Significant risk and rewards are transferred. Let's say when I dispatch goods to the customers, or I deliver goods to the customers. In fact, there are some who actually say if it's a retail customers, it is on delivery, but if it is to institutional, it is on dispatch. So those distinctions are there. So the expectation is you go to that level for each stream of revenue, and then explain what a transfer of control means, what transfer of significant risks and rewards mean. Right? So don't give boilerplate disclosures. Don't pick words from the standard, because at the end of the day, this is an accounting policy for the company. It is not a repetition of accounting standard. Right? So that's the first one. The second one, again, I think it's related to the first one. You need to tell your own story. We've looked at the primary financial statements. There is some understanding that a user will get from the numbers, but unless and until you explain what has happened during the year, that story remains untold. So the financial statements and the notes have to tell their own story. And the next one is that it should provide the information in the financial statements in an easily accessible way. And this actually means how do you arrange your notes. If you have a revenue note, it makes more sense for you to give disclosure of disaggregation of products, services that you have, and maybe even the terms of sale, whether it's point in time, over time, all those terms of sale also below the revenue note. So a person who's reading the revenue note gets full information of your product, services, timing of recognition of revenue, maybe even geographical area, where do you sell, where are your customers, all that information. It makes more sense to give it under the revenue note rather than giving it in note 50, which is 20 notes away from the revenue. Think about materiality. It is not necessary that you have notes, accounting policies for immaterial items. Because a person who's reading a financial statements, it will become a battle of attrition for him if you have accounting policies and note disclosures for items which are not material. So if there are items not material, you make a disclosure that these disclosures are not provided because it's not material. Similarly, on the contrary, if there are material items, you need to ensure that accounting policy and the disclosure notes are provided for all material items. Now, one of the checks that we generally do is when you're preparing the financials, you look at your revenue note and see if there are different streams of revenue. Is there an accounting policy for each of those different streams? Similarly, if you have look at your intangible note, and if you have different categories of assets under the intangible note, you'll have to ensure that your accounting policy covers a useful life for each of those items. One of the other things that is very common now, we should also take cognizance, is that financial statements are not standalone. Because generally when these financial statements are published, they're published along with an annual report. Now, it should not so happen that you give a different story in the notes and a different story in the annual report. So it's important that you compare the financial statements and the notes, and also the front part of the annual report, which is essentially the board report, MD&A, and all those sections, and ensure that there's a consistent story. It is not that here you will say that my revenue growth for impairment purposes 20%, and that there's a big disclosure of this is the significant accounting estimates that I've made. But when you actually go to your MD&A and board report, it's only 10%. So that becomes inconsistent. So that consistency has to be ensured. Okay, so that brings us to the end of the critical accounting estimates and judgments section. I'll just pause here for a minute for any questions. Otherwise, I would continue. You can see the full screen. Is it on that laptop? I can't see it here. I just
No, you can use the third one. Third move. Yeah, I think you will just solve the first one.
no. Okay, so if there are no questions, then I'll continue. So this is the last section, and this is generally the section where you get the most number of pages that are consumed in an annual report will be the notes to the financial statement, because there are 35 accounting standards, and each standard has n number of disclosures, so you have to comply with each one of them. So this is essentially the part where a lot of requirements are specified in the accounting standard, and you need to tick off each of those disclosures. Generally, what we do to achieve this completeness of disclosures is that we do use checklists to see that all the requirements in the accounting standards are ticked off, and it's a very easy way to ensure that completeness is ensured. But for the purpose of this discussion, I did not focus on repeating all the disclosure requirements, because that's going to take maybe a day or even 2 days to explain all the disclosures. But what I've done is I've tried and highlighted certain items which are glaringly sticking out, and maybe sometimes people can interpret as an error, which we need to clearly avoid when you prepare looking at the notes to financial statements. But if you have any other experiences, please do share it with me and with this group. So the first one that I picked out was that one of the requirements in Ind AS 12, which is a standard on taxation. Again, the disclaimer that I'm going to give is this is based on Ind AS financials and Ind AS standards. There could be similar requirements in IGAP, but some of these examples that I picked are silly examples where error has happened by oversight, but it does stick out. Right? So one of the things that Ind AS 12, which is the standard on taxes, requires that you'll have to prepare a reconciliation of your tax rate with the income tax rate that is announced by the government, which is called as a statutory rate. But when you see those disclosures, people actually disclose temporary items. So you have an item where you let's say 43B item. Today you disallowed and you created a deferred tax asset. Next year when you get it, you get a deduction. So that's an item which is temporary, and typically when you look at a reconciliation, it should not come as a reconciling item, because it's got both deferred tax and current tax impact. Right? But when you see number of notes in the financial statements, this line item is coming as a reconciling item, which is actually incorrect, which actually sends out a message to a user that reconciliation is incorrect, or maybe the deferred tax computation is incorrect. Right? So that's an example. Also, the standard on taxes requires that if you have carry forward losses, brought forward losses and depreciation, where you not recognize a deferred tax asset, the disclosure, there should be a disclosure of the amount of such losses, and also when it's going to expire. And we generally come across situations where companies don't want to disclose this because the information is deemed to be confidential or sensitive. I mean, Ind AS standards or no accounting standard gives cognizance of confidentiality. This is a requirement and it has to be disclosed. Another common thing that we see, and it's across, is that if you've done impairment test, the standard requires that impairment test has to be done at CGU level. Now, once you do it at a CGU level, the disclosures that are to be provided in the financial should also be at a CGU level, not at a company level. Now, typically what happens is when the disclosure, when the impairment test is done, it is done at a CGU level, but when it comes to disclosure, it's done at a company level. Or it's very hard to understand from the financial statements what is the CGU and whether the disclosures are at a CGU level. So that's another thing that has to be taken care, because yeah, so that's again on impairment again, when you have a situation where you've done an impairment test today, you are good with whatever assumptions you put in the model. There is no impairment provision that you booked, but it could be a near miss because you considered a 20% revenue growth rate. There is no impairment today, but if it is 18%, it results in an impairment. In such a scenario, you'll have to disclose that a mere 2% drop in revenue growth rates that are considered in the model will result in an impairment, and that has to be disclosed in the financials. Okay, so I think this is very common. This is applicable even in Indian GAAP. This is on provisions and contingent liabilities. Typically, we see that movement schedule for provisions. We also see the contingent liability disclosure saying this is the amount for this is income tax matter, sales tax matter, or it could be a commercial dispute. But most financial statements don't provide qualitative disclosures. When this is likely to be paid, what is the nature of the dispute, right? So those are things that are mandated by the standard and it has to be disclosed. This is another one that we often see when companies make acquisitions. The requirement is users have to know what have you acquired. So the requirement is that for that business that you've acquired, you need to disclose what has been the performance of that business in the last 1 year. You'll have to disclose how much when you make the acquisition, you may have made it from beginning, not from the beginning of the year, but during the year, sometime during the middle of the year. When you made that acquisition, how much is the revenue, costs, profits that you consolidated, right? So those disclosures have to be made in the financial statement. So a user gets an understanding of what did you acquire, what is the performance of that business that you acquired. Also, one of the things that can happen is when you make these acquisitions towards the end of the year, you might not have completed the business combination accounting. In those cases, you have to disclose that the business combination accounting is incomplete. And you also have to disclose the reasons why the business combination accounting is incomplete. Right? So that is an important disclosure. This is another one which is again specific to Ind AS. I think there's a gap difference here in Indian GAAP and Ind AS. Under Ind AS, independent non-executive directors are considered as KMPs. Sometimes we do see that independent and non-executive directors and their compensation is not disclosed as related party transactions, and they are not considered as KMP. But I think that's an important one. I think there's a clarification even from the institute on ITFG's issued a clarification on this. Okay. So moving on, if you look at a segment disclosure, one of the requirements is that if your business is reliant on, let's say, a few customers, I think the threshold is 10% of your total revenue. External revenue comes from a few customers. You need to disclose that information in the financial statements. And often we hear arguments to say that it's confidential. We would not want to disclose this. But what is important to understand is that names of the parties need not be disclosed. All that information that is required is to make a user understand that there is a risk of concentration. So that to that extent, there should be a disclosure to make the user understand that there is a risk, and if that customer goes away, this is going to be the impact on my P&L. If that customer sits in a particular segment within the P&L, we'll have to disclose in which segment does this customer sit, right? Or customer's revenue sit. We also see certain places where companies conclude that there is only one segment, and that's the only piece of information that is given in the segment information. What is important is to know that the standard also requires some additional information. Despite the fact that you may have only one segment, you may have revenue from customers outside India. You may have assets which are working outside India. So the standard requires, even though segment disclosure itself is not applicable because you are working in a single segment industry, these additional disclosures are required. In that scenario, even that concentration where you have a risk of few customers to whom you sell, even that disclosure is required. So just because the primary segment disclosure is not applicable doesn't mean that these additional disclosures are not applicable. One of the other things that we commonly see is that companies actually make reclassifications in the comparative information. So you may have, for whatever reason, classified a certain item in the balance sheet as financial asset last year. Today you realize it's not a financial asset, you put it in other asset. Now that's a reclassification. In Day's world, this is called as a reclassification, and that's akin to an error. And when an error happens, you'll have to comply with the requirements of Ind AS 8 for error disclosures. So it is not that you will make a reclassification in the balance sheet, material reclassification in the balance sheet without any additional disclosures.
Then have to present 3 balance sheets.
Again, that requirement that we spoke about for accounting policy, that it has to be material for that year. If it is material for that year, you'll have to present. Otherwise, you'll have to do it in the, even if it's an immaterial error, you can do it in the current year itself. You don't have to reclassify. But the problem is you can have material reclassifications without an explanation. That's a miss.
Even a small, let's say, expense, classified from operating expense to other expense. Even then, if it is material, it would be.
So within the note, it's fine. So what should not happen is in the primary financial statements, the line should not change. Then that becomes a reclassification. Another thing that we generally see is disclosures on liquidity risk, and this is a specific requirement for India, is not applicable for Indian GAAP again, where you'll have to disclose when you have, let's say, borrowing or a lease liability. You have to disclose when are you going to settle these liabilities. How much are you going to settle in 12 months, 1 to 2 years, 2 to 5 years? So this is a disclosure that is required, and the ask is that you will disclose actual cash flows, meaning you will have to disclose including the interest component. But when you record it in the balance sheet, you would have recorded the discounted amount. But the requirement is you have to disclose the undiscounted amount. But typically we see that people disclose the discounted amount, and because I think the tendency is you will look at the balance sheet, and when you look at total this table, it will match. But here the requirement is it should not match. You should disclose the actual cash flows, not the discounted amount. Another thing that we often see is also that there could be a default in repayment of a principal and interest. But before you issue the financial statement, the default is set right. So when you actually set right the default, there is a tendency to believe that there's no further disclosures required because the event has happened. I've set it right. There was no other problem in the that I need to make, no other disclosures that I need to make to investors. But actually, the standard requires, even if in such a case where you actually remediated the default before the financial statements are issued, even in such a scenario, you should make the disclosures that there was a default and this was remediated. This is another common thing. Maybe this is the last one that I have, I think. We are used to providing movement schedules for PPE and intangible assets. One thing that we often miss out is that we don't provide it for CWIP and intangibles under development. What is important to note that even these meet the definition of a PPE. It meets the definition of an intangible asset. Just that these are in the various stages of development before it becomes capitalized. So when you have such line items which are material, you will have to provide a movement schedule even for that. So that brings to the end of my session. In case there are questions, I'm happy to answer.
Is it possible to believe that before tax installation which common not get it?
So I mean, the question is when you have a let's say a
I have listed 43B items.
43B item leave encashment, let's say. So you create you disallow it for tax purposes this year because it's not paid, and you create a deferred tax asset. Next year you'll get a current tax deduction. So in the year in which you make a disallowance, you would have disallowed it for current tax and you would have allowed it, you would have created a deferred tax asset. So what reconciliation that you're preparing is of the total tax expense. both current tax impact and deferred tax impact, the total of those two lines is nil. So it's not a reconciling items to be disclosed. Generally, in the reconciling item, you will get items like it has not impacted your tax rate, right? Because you adjusted both the current tax and the deferred tax. Generally, the items that you get is CSR, for instance, which is not allowed at all. Or let's say interest on income tax or interest on some other indirect tax, which is not allowed for tax. Only those items should come in the reconciliation.
So remaining things I know you pull it up.
Yeah, it does. It should not. It would not impact your tax rate.
Yeah.
Overall, it's it has got a zero impact on your tax rate.
Depreciation in the WDV of the asset that generally we show in the deferred tax computation, and we show it as an annexure or notes to the annexure. And we show the entire is that practice.
That's fine.
But we are not showing assets in the notes. Like in the notes, we are just mentioning the deferred tax amount of computation. But the annexure, we are showing the computation.
That's okay. How do I see if there are questions? Only you can see, is it?
There's a queue on the
This one.
second.
Shall I close this? Okay. I think there's one question which says, can the accounting policies, could they be distributed or maybe in one place? Actually, good question. I think in India, the practice is we club all accounting policies in one place. We've structured it in a manner where we start with the primary financial statements, accounting policies, and then we start with the notes. But there is no hard and fast rule. So in fact, globally, there is a trend that because accounting policies, if you see currently, it's part of the notes. There's no difference between the notes that you have where you disclose the requirements of the standard and the accounting policy. So globally, as I was saying, the trend is that you provide the accounting policy and the notes together, and that is an acceptable practice. Again, so I think it answers the question. You can have main accounting policies, the significant accounting estimates and judgments, and the disclosures as per notes in one place. Let's say a revenue note, you will start with the accounting policy. You will provide the significant accounting estimates and judgments and provide all the other disclosures. So that's acceptable.
The trend in India is also seeing only published account.
Oh, is it? I've not this year. Actually, we are illustrative. Our global illustrative, we are following that, where we club everything together.
Okay, probably in the reference financial statement.
That's possible. Yeah.
Chat box. The one which is blue up.
Yeah. Yeah.
Thank you, Praveen sir. Hello. Am I audible?
Now,
Yeah, thank you. Thank you for excellent presentation. I hope our members are greatly benefited by your session. As we discussed, it's a very, very important aspect of any financial drafting. If they adapt and implement in their regular audits, really it will be helpful for them as well as the third party which is going to review or view the financial. They'll get a clarity about the financial as well as the auditor who has done the work. Really, it will help a great way. Thanks a lot. I thanks all the members and participants, those who actively participated. I request our Secretary Pramod to present a memento to the Praveen sir as a token of gratitude and respect. Thank you, sir. Thank you all members for actively participating in this program. Thank you.